Now, I think we're going to be entering a new gold cycle like we saw in the early 2000s, like we saw in the 70s, but potentially the most important gold cycle we've seen in history. And this is given the fact that in the 70s and the early 2000s, we didn't have a trifecta of macro imbalances, and today we do. And that's going to allow gold, and we were not operating in a gold standard today, which is different than the 40s. And so likely, this is going to be just the beginning where metal prices will take off from here, and I think will create influx for the precious metals industry, and silver will outperform gold because it's what happens during gold cycles. And so I'm really excited about what's ahead.
With a keen eye for economic trends and a deep understanding of macroeconomics, Tavi Costa has garnered attention for his accurate predictions and valuable perspectives on various asset classes. In this video, Costa shares his outlook on potential sell-offs in the precious metals market, focusing on gold and silver. Analysts believe silver could outperform gold if the Federal Reserve achieves a soft landing. Historically, the seasonals are strong for gold. From July 18th through to August 27th, gold prices have gained 70% of the time over the last 10 years, with an average return of 3.17%. Tavi predicts that despite some skepticism in the media, gold will likely resume its upward trend and prove to be a haven asset. Gold prices have risen about 5% since in June, when they hit over 3-month lows, with recent price gains mainly on the back of U.S. economic readings backing views that the Fed will on July 26 raise interest rates by 25 basis points on the last increase of the current tightening cycle. During the prolonged economic crisis resulting from Russia's invasion of Ukraine in 2022 and the subsequent banking crisis in 2023, Costa emphasizes gold's role as a safe haven investment, outperforming traditional assets like stocks and bonds amid uncertainty and turmoil. The financial chaos triggered by the collapse of Lehman Brothers in September 2008 led to gold prices jumping from a little over $700 per ounce to $1,900 an ounce by October 2011. During this period of 3 years, the equity markets around the world were volatile, and investors were heavily relying on gold to preserve their capital. After 2011, the gold price declined as the stock markets gained stability. Costa explains that investors should consider the gold to S&P 500 ratio instead of just calling for a recession to better position their portfolios. 2008, the gold to S&P 500 ratio peaked at 2.02. The ratio declined sharply during the financial crisis, reaching a low of 0.81 in 2009. Tavi's analysis shows that this ratio tends to perform well for about 2 years after getting a certain level. Meanwhile, he expresses strong confidence in the current state of the gold industry. We will now bring you clips of Tavi Costa from his recent interview with Liberty and Finance. Before proceeding further in this video, please subscribe to our channel and click the bell icon to stay updated.
It's going to be sell-offs, obviously, but I think it's we're off to likely to be breaking out from a lot of large resistance that we've seen in the past. For gold is the triple top. The triple top, created a historical resistance. We've had a sell-off, that lasted about 2 months or so. Absolutely normal. The sell-off wasn't as severe as a double top, like we saw back in when Russia invaded Ukraine, and we had gold surge and then hit a prior high, and then completely, fell apart for the following months. This is very different. And so, today, we hit another time the same level, which formed the triple top. We sold off, and and then we have headlines on Bloomberg, coming out saying, that gold is unlikely to be a haven asset, and you can see the skepticism on the wall, of towards the metal. And then you look at silver prices. There is a massive, decade-long resistance on silver, in a downward trend that we've had over the, call it, 12 years or so. And every time we've hit this resistance, a major sell-off happened. Is this going to be the case again today? I mean, we hit this resistance so many times. I feel very strongly this is the end of it. We're probably going to be breaking out along with gold prices. It would make sense if those two coincide. Now, my idea was, okay, well, calling a recession is not really a effective way of running money. So I really need to understand what's the best way to position a portfolio. And we've had times when gold performed well and gold didn't perform as well. So '08 was a classic example where, there was a decline in gold prices as this whole environment played out. But gold outperformed equities. That's an important aspect. The gold to S&P 500 ratio increased not because gold was rising, but because the S&P 500 was absolutely getting murdered at that time. In early 2000s, we saw both legs of that trade working. Gold was rising, S&P was falling. And so, there's all sorts of instances. And I looked at treasury markets. Treasury markets work really well as a protective asset until you get to the inflationary eras like the 70s. And so, kind of what we saw here recently. And so, all those things are kind of playing a role into how to really understand positioning when you have the 70% handle. But my empirical analysis shows that by far the best thing to own is the gold to S&P 500 ratio, because you just don't know which one is going to work better. But the ratio itself tends to perform very well for the next 2 years after you get a 70% handle. And so we had that in November. The ratio was working really well. Recently, we had a pullback, which is normal, by the way. We've had other pullbacks in the past. And around July, in my calculation of average performance, is sort of when you start seeing that really take off again, which is interesting that we're seeing that now. I don't know if this is going to play out exactly time-wise. The seasonality of all this is going to be exactly the same, but it's, potentially there is a case there too. But what's more interesting is the fact that, a stagflationary environment like the 73, 74, or the early 2000s, where we had a very, very speculative environment of really excessive valuations and so forth. You look back on those two periods, the return, the average return of this ratio of owning gold and selling S&P 500 actually was, way better than the historical average of the other time.
During the interview, Tavi Costa shares his insights on the current economic situation and its potential impact on gold prices. Following a historically high level of central bank gold buying, gold continues to be viewed favorably by central banks. Our 2023 survey revealed that 24% of central banks intend to increase their holding reserves in the next 12 months. Tavi suggests that the gold accumulation by central banks sets a precedent for large institutions. It shows that gold is seen as a valuable asset by some of the most sophisticated investors in the world. The headline in the core U.S. CPI print missed the forecast this week as inflation continues to track lower. This week U.S. CPI print gave both gold and silver the expected lift as the U.S. dollar and yields fell. On the other hand, he predicts that the unexpected resurgence of inflation will catch many people by surprise and have a notable effect on the tangible asset market. Let's get back to the video.
I feel very strongly about that, and I think this is absolutely a pivotal moment for the overall industry, because it's what we were waiting for, is a big run up in gold prices that will bring the influx of capital towards the overall industry, which is something we haven't seen in a very long time. And so, this is a technical formation that tends to not hold, but that's not really where I believe this is where the thesis really stands on. I think the overall case for owning gold today has never been, so diversified across all these drivers. It is the production story of most of the majors actually having, not really focused on growth and ultra conservatism. And so you have a secular decline in production across most of them. It's the fact that, we've got a situation where central banks have been accumulating the metal as a way of really owning a neutral asset. And that tends to drive large institutions such as 60/40 portfolios, endowment funds, and so forth that run more in a traditional manner, and likely will be looking for different alternatives for defensive assets. And I think gold will play a role, like is doing for most central banks, will do the same for those institutions as well. This is something we didn't see in the 70s or in the 1990s, or I should say in the early 2000s. The deglobalization trends that we're seeing, that is causing most of the economies to really reshore their manufacturing plants and so forth. And that's causing a construction boom. It is similar to the if you look at construction spending, it looks like the NVIDIA chart. It's going on a vertical line, and that will have we're going to need stuff and commodities and so forth. So we're seeing likely the beginning of a commodity bull market. And then you look at the capex trends of most of the producers in the space and in gold and other parts of the resource industries. I think we're in a position right now where inflation is probably going to be it's probably close to a bottom, and it's very interesting. Everyone looking at the CPI number, which is kind of backward looking in my view. And at the same day, you're seeing oil breaking out. You're seeing other commodities doing very well. You're seeing gold rising. You've seen silver surging. What does it all mean? This is not a not a market I would be be betting against inflation here, because I think it's going to be coming back in waves, and we just saw the first one, and we're probably approaching a bottom here of inflation. And once that happens, I think it's going to surprise a lot of people, and it's what drives the tangible asset market in a large way, and why I think commodities will perform so well.
Silver prices have been outperforming their golden counterpart recently, outpacing gold by nearly 4-to-1 in July. The measured move target of 2007 and resistance at 2010 indicate further upward momentum for gold. How do you think the current events, including inflation, will impact the performance of gold as a safe haven investment in the coming months? Share your thoughts in the comments section below. If you find this video informative, remember to show your support towards our channel by giving this video a thumbs up and subscribing to our channel, and turn on notifications to stay informed about our latest videos covering more exciting topics. Thank you for watching.